the banks that serve Main Street must have the same chance to succeed as the banks that serve Wall Street. But the post-crisis regulatory framework has instead become a threat to the community bank model. Since 2010, we've lost 3,600 community banks, a reduction of over 45%. Community banks' share of bank assets have fallen from 23% to 15%. Their share of outstanding bank loans has fallen from 27% to 20%. Their share of outstanding bank CRE loans has fallen from 52% to 41%. This represents an acceleration of trends that predate the 2008 financial crisis. And in a disturbing new development, de novo chartering has dropped precipitously, averaging just 6 new banks per year since 2010. For comparison, in the years prior to 2008, there were 100 plus new banks chartered each year. The post-crisis framework has left a trail of destruction in its wake by reinforcing the larger economic dynamics that have hollowed out the American heartland while enriching the money centers in coastal cities. To be clear, the financial crisis underscored the need for new regulations. The purpose of Dodd-Frank was to end too big to fail, but it ended up creating too small to succeed. These new regulations entrench the dominance of the largest banks by rewarding economies of scale and necessitating effective lobbying operations here in Washington. What followed was a community bank bottleneck that left America's hometowns reeling. President Trump and this administration have seen what the heavy hand of government has done to community banks and the families you all serve, and he has set out to fix it. Why? Because we know that the Main Street revival starts with a community bank comeback. How will we position community banks to succeed? Let's start with the early wins. Just days after President Trump was sworn into office, the administration began rolling back the regulatory excesses of the Biden years. The regulators ended the politicized use of reputation risk and supervision. They proposed to rescind an embarrassing, complicated 60,000-word Community Reinvestment Act rule, and they retracted a merger policy statement that was both bad policy and bad law. The previous administration pushed for rules and guidance that micromanaged corporate governance, entangled the bank regulators and climate risk management, unduly restricted brokered deposits, precluded responsible bank innovation in crypto and other blockchain technologies, and imposed arbitrary restrictions on incentive compensation. These Biden-era proposals were bad for banks, bad for business, and bad for America, especially Main Street. So President Trump slashed all of them. To restore the strength of community banks, the new administration has replaced this draconian agenda with a new, more constructive agenda. The FDIC, for example, has recommitted to tailoring by proposing to raise and index asset thresholds. It has streamlined examination procedures and branch applications. It has started work to reestablish a supervisory appeals body. Not to be outdone, the OCC has implemented its own reforms. Controller Gould has been on the job for only 12 weeks, but he has already reduced assessments on small banks by 30%, reversed the plan to merge community bank supervision into large bank supervision, and replaced community banks' formulaic examination schedules with a more risk-based approach. Vice Chair Bowman, meanwhile, has long advocated for revisiting the community bank leverage ratio. I expect that effort will soon culminate in a proposed reduction in the community bank leverage ratio. The CFPB, for its part, has started to revamp the Section 1071 reporting requirements and reconsider the open banking rule. And it has withdrawn more than 60 interpretive rules and other guidance documents. Following the administration's example, Congress has also taken up the effort. It has nullified the CFPB's overdraft rule, and prohibited the furnishing of mortgage-related trigger leads. The House Financial Service Committee has likewise advanced 24 important reforms to community bank regulation, while the Senate Banking Committee held a hearing and hopefully will soon mark up an expansion of FDIC insurance on non-interest-bearing transaction accounts. There is still much to look forward to on the regulatory front. This includes 2 new proposals that will reset the culture of supervision. 2 days ago, the FDIC and the OCC proposed a rule that would codify the recently adopted prohibition on using reputation risk as a basis for supervisory criticism. The FDIC and the OCC also proposed a rule that would define unsafe or unsound practice or condition. While simply defining a term might sound like a small thing, it marks a big step forward. Only in the world of unaccountable regulators could a key concept have gone unidentified for so long. The past failure to define this term led to supervisory criticisms focused on process or documentation related to governance, model management, and third-party risk management. In other words, topics that often had little or nothing to do with a bank's actual financial condition. This regulatory myopia was a driving force behind the spring of 2020-23 bank failures. Once finalized, a clear focus on material financial risk will put an end to this nonsense. I'm also optimistic about AML CFT reform. In my meetings with community bankers, they list CTR filings, structuring SARs, and process-focused examinations among their top concerns. Today, FinCEN released FAQs to address pain points on some of these issues, including triggers for restructuring SARs, continuing activity reviews, and the absence of any requirement to document a decision not to file a SAR. These are common sense, yet consequential reforms that will ease regulatory burdens without undermining law enforcement efforts. As part of our broader campaign to modernize illicit finance regulation, FinCEN and the bank regulators are hard at work on a new rule to define the requirements for an effective AML CFT program. My expectation is that a proposal will recenter supervision where it should be, on the effectiveness of a bank's AML CFT program. I likewise expect that proposal will position FinCEN as a gatekeeper for AML CFT enforcement. This will be a significant departure from the past with its zero tolerance focus on process, documentation, and wide latitude for supervisory expectations and judgments that are not always consistent with the law or our national security priorities. A focus on higher value activities will also better serve our law enforcement and national security objectives. These are all important victories, to be sure, but much work remains to be done. Where do we go from here? Going forward, Treasury will continue to drive reforms to improve regulatory tailoring, refocus the culture of supervision, and modernize our illicit finance regulation. Specific priorities will include reforms to the rating system, new processes for monitoring examiners' compliance with supervisory policy, mechanism for independent appeals of supervisory criticisms, coordination to avoid duplicative examinations by different regulators, and review of the core platform providers, including contract terms that prevent community banks from innovating for the future. For community banks to go back in the offensive, we need to take a closer look at the dynamics that have undermined the community bank model and work to fix them. To that end, as I have said before, Treasury is focused on ensuring that modernization of our capital framework ends the capital arbitrage that drives bank lending to non-banks. This will likely entail reduced capital requirements for large banks on mortgage loans, investment-grade corporate loans, and some other important exposures. We must therefore ensure parity by giving smaller banks at least the option to benefit from these reduced requirements. Treasury has also supported congressional efforts to modernize the deposit insurance framework. I'm encouraged to see emerging bipartisan support for increasing FDIC insurance limits on non-interest-bearing transaction accounts. In addition to these efforts, Treasury has taken an informed and careful approach to Fannie Mae and Freddie Mac. Any actions on the GSEs must not increase borrowing costs and must preserve what works in the current system. That includes the prohibition on volume-based discounts for large lenders, as well as the cash window and other features that preserve equal secondary market access for small lenders. Now, allow me to close with a call for action. Before President Trump took office, community banks spent decades on the defense. But under President Trump's leadership, the game has changed. The playing field will be even more even. The ball is in your hands again. What happens next is up to you. So my advice, go on the offense, retake market share, chase after customers, champion technology, leverage the new regulatory landscape to your advantage, and expand your role in the American economy. The community bank comeback will help pave the way for America's golden age. Recognize the outsized role you play in this effort and embrace it. Because if you lead the way, Main Street will follow. Thank you.
Thank you, Secretary Bessent. It's wonderful to hear a Treasury Secretary. I'm not sure I've ever heard a Treasury Secretary talk about community banking and the importance of community banks in the United States and for the U.S. economy in my lifetime. So it's really refreshing to hear you engaging on things that are so important to areas like where I'm from and rural communities across this country, and how important community banking is for the foundation of our economy and the economic system. So if you don't mind, we'll start with a question, and thank you for joining me for some a fireside chat this morning. But as Treasury Secretary, you oversee U.S. fiscal and macroeconomic policy. So I know every banker in this room is interested to see how you think about how the economy is going to develop over the next 12 to 24 months, and what key risks and opportunities should they be thinking about and looking out for as they're thinking about how to shape their businesses going forward.
Well, I come with some good news this morning, and Treasury, because of the Schumer shutdown, will not be able to release the exact numbers, but the CBO jumped the gun a bit, and it was on Bloomberg this morning that the deficit for this fiscal year, ending September 30th, will be slightly lower. When I went to see President Trump and more importantly, the deficit to GDP now has a 5 in front of it. So according to the CBO numbers, and we don't have the Treasury numbers yet, the deficit to GDP will have fallen from about 6.5%, which was the highest when we weren't at war or weren't in a recession in US history, to 5.9%. When I went to see President Trump approximately 2 years ago to tell him that I'd like to come out from behind my desk and get involved with the campaign. Not going to repeat many private conversations, but this was particularly notable. He looked at me, first thing he said, Scott, how are we going to get the debt and deficits down and not cause a recession? And we're on our way. I think we saw that today. So I think the president's economic policy, as many of you would have seen me say before, is a three-legged stool: trade, tax, and deregulation. The tax bill, the one big beautiful bill, has incentives for both corporate America in terms of full expensing for plant property and equipment, and the plant part is new. In the Tax Cuts and Job Act 2017, there was full expensing for equipment, but we have added structures for both industrial structures, and importantly, agricultural structures. So, uh, secondly, on the other side of the ledger, it also includes the president's tax policies or campaign promises for working Americans: no tax on tips, no tax on overtime, low tax on Social Security, and interest deductibility if you buy an American car. I think one of the things that we are seeing now, most taxpayers have not changed their withholding stance to reflect this. So we expect to see substantial tax refunds beginning of next year, which I think will be accrue to lower end consumers for the bottom 50% who need the relief. And concurrently, they will change their withholding schedule so their real take home pay will be higher next year. On the trade deals, I think one of the underreported aspects of the trade deals is not only are we taking in substantial tariff revenue uh, for our American exporters, we have brought down non-tariff trade barriers and brought down tariffs across the board. So with many of the deals that we have gone from high tariff levels, and I tell you, like, for instance, Indonesia was very good about bringing down their tariff levels, but when they showed you the list of 9,000 tariffs that they had, you couldn't believe it. So, and like President Trump said, I don't blame the Indonesians for doing it. You blame the folks who were sitting at the Resolute desk for letting it happen. So on trade, we're landing the trade deals. That will increase certainty. And then finally, on deregulation, we talked a lot about financial deregulation, but we're also talking about energy and industrial deregulation. We're trying to make it easy to build things here again in America, whether it's permitting for factories, for pipelines, for the electric grid. So I think I'm very optimistic that 2026 could be a very good year across the corporate and the consumer economy.
Well, thank you for that. You've been very busy since you got started earlier this year. So thank you for sharing that. And I think that's a very optimistic view about how the economy will be evolving. I think in the relatively near future. Thinking about that, community banks are critical in providing local and regional credit throughout their communities, through small towns, through rural areas, and in underserved markets especially. So you talked a little bit about what some of the initiatives are that Treasury's been working on with the prudential regulators. Are there other areas that you'd like to focus on or to share with us today that might be helpful for bankers to know?
Well, as you said earlier, I may be one of the few, if not the only Treasury Secretary who's given this much emphasis to community banks, probably the only Treasury Secretary since the 17 or 1800s who was, well, there wouldn't have been farm radio, but is also a farmer. So I remember listening to farm radio uh, right after the Silicon Valley debacle or the three bank debacle. And they were talking about the risks to community banks that were happening, that could be happening here. And I was just struck by what the presenter was saying. He said, the big banks, they're going to come in, they're going to buy up our banks. They don't play Little League baseball with your son. They don't play softball with your daughter. They don't go to your place of worship. They don't know you from the Rotary Club. What are we going to do? And so we are committed, as I said, I'd like to see us getting back to de novo banks. Again, it's a sign that when you see creation of something, it's a sign that the ecosystem's healthy. So we want to get back to de novo. We want to get back to leveling the playing field. I think these transaction accounts are very important. Oh, we try at Treasury, we try to meet with dozens of community banks, whether it's one-on-one or in groups every month. And one of the main asks that we got was increasing the non-interest bearing transaction account. So we've been working very closely with Senator Tim Scott on that. And I think we haven't landed the exact amount yet, but I think that that legislation is going to move through.
Well, it's wonderful to hear some progress in some of these areas that have been a topic of conversation for a number of years. So thank you for your support in working towards some solutions in that regard. Later today, we're going to have a panel of community bankers to talk about capital and liquidity regulations. So I wondered if you might be willing to share your views and thoughts about how we could appropriately calibrate those capital and liquidity levels, especially for community banks, but maybe more broadly across the banking system to be more effective for economic growth and how to support the economy going forward.
I think if we take a step back, we could see that the substantial amount of credit that is being grown outside of the regulated banking system tells you that uh, the regulatory framework that was developed post Dodd-Frank is too tight, and that there is this substantial arbitrage to be done, whether it's vis-a-vis big banks, whether it's small banks. Why do we have why do we have private credit that is bundling loans and then receiving lines of credit from banks? Let's get back to the primary lending function. Let's make capital more risk-based. Let's understand that there's a lot of work to do in terms of uh, bringing this back down to common sense levels in terms of knowing your client, in terms of um, releasing what I would say is this regulatory straitjacket. And famous last words, I think private credit is a dynamic new aspect that increases the depth and breadth of the US financial system, but it can't be to the detriment of the regulated system, because my real worry with private credit is everyone in this room, all the bankers, and look, you know, I met a lot of banks who've been going since the 1800s. And if you've been going since the 1800s, you know a lot about risk management. You know how capital works. You know how your clients are. Um, that um, my worry with private credit is it could be very pro-cyclical, that without stable deposits, in terms of if there were a downturn, the way Treasury, Federal Reserve would work together would be with window guidance, would be with regulatory lessening the regulatory the parameters, and to restart the economy in a counter-cyclical basis. So we also want to look at that. And again, too, a lot of the things we want to do, we want to make it easier to operate. We had a small community bank from South Carolina a couple of weeks ago in one of our panels. I think it was 185 million of assets, 17 employees. I think 5 were for compliance. So, and no one is more focused right now on financial crimes. Our FinCEN department is 24/7 in terms of what we are trying to work on, but we're also trying to add a common sense layer. Can we do geographic targeting? If we see that a huge amount of the narco finance is along the border, should we lower SARs there and raise them everywhere else to avoid all this regulatory expense?
Well, I think that's a very important topic for many community bankers as they think about some of the regulatory burden and requirements that they're not sure what happens to once they send it forward. One thing I want to just pull a thread on is you mentioned the importance of ensuring that we have the ability as regulators and bankers are not disincentivized from participating in different types of activities. One thing I would point to, and I have many times over the years, is to talk about how important it is that we're pulling some of these activities back into the regulated financial system, especially real estate lending and mortgage servicing and things of that nature. So I know many of these bankers in the room are hopeful that we'll be able to think about that differently. So when you discuss the regulatory perimeter, I think that's a very positive path for discussion, and we'll look forward to engaging on that.
And Look, I mean, no one knows when you talk about real estate, no one knows the real estate landscape like local bankers.
Absolutely.
It's maybe there's some banks around the Ozarks who like lending down in Florida, but I hope they're successful. But I will tell you that community banks. I'm sure all of you read all the news reports. Oh, community banks hold all the small community banks. It's going to be a debacle. They hold all these CRE loans, and for 15 or 20 years, initial 15 or 20 years of my career, I was a banks and insurance analyst. So I know how banks work. I may seem exciting, but I used to read state insurance call reports.
Those are fascinating.
Gripping, gripping is the only word. But I can tell you that to the extent I was successful was being fact based and not narrative based. And as we dug down on what was supposed to be a CRE wipeout for community banks, it turned out that they really weren't CRE loans, that they were business loans. And we just went out and talked to small and community bankers. They were business loans where the business person put up their building as collateral. So you didn't have a loan on a part of a strip mall. You didn't have a loan on a pod. It was an accounting firm that was financed. Had a loan to an accounting firm. You had a loan to a law firm. You had a loan to a medical practice. So, and only community banks know that.
Well, it's refreshing again to hear the Treasury Secretary talk about community banking in a way that helps us recognize that you do have a background in it and that you're serious about the words that you're saying in support of community banking. So thank you for your commitment to that and for sharing that with everyone here today. One thing everybody's a little bit concerned about going forward is the shift in the technological landscape. And banks for a long time have been innovating. It's been a hallmark of the community banking framework and their survival since the 1800s, which I have to say thank you for mentioning banks that were founded in 1800s, because my family's bank was chartered in 1882. So that's a little peace of mind here that you think that they understand their risks. So I'll have to share that with my cousin. But on innovation, banks have been partnering with fintechs for a number of years now, and we continue to add more and more requirements about third-party risk management, and oftentimes they don't make sense, or they conflict with each other, or they contradict what the requirements are. As we're thinking about how the landscape with technology, with AI, with stable coins and other types of new business services and activities are being brought forward through the sponsorship of legislation and new regulatory frameworks for stablecoins and things like that. Today, we have the Robinhood CEO and also the Paxo CEO to share their views on how community banks can engage or think about how that will look going forward. But how do you see the role of technology evolving in the banking sector? And what policy levers do you think that we could use to help ensure that community banks can compete effectively in the new technology environment?
I think it was very important. If I look, and one of the biggest regulatory changes from the Biden administration to the Trump administration, there have been a lot of them, is our emphasis on AI and digital assets. AI in the Biden administration was governed by diffusion. They were going to treat it somewhat like the nuclear program, keep it in a box. They were going to hand it to Google, Microsoft, Meta, and that was life. On the other side, digital assets had a near extinction event with Wells notices going out to many companies, banks prohibited from opening accounts. And I think the fact that we're creating, the term is sandbox, where there's a lot of experimentation, where there are a lot more offerings, and for community banks not to be locked in, that they have to use like one of three dominant service providers, that for a wider range, supply will push down price, choice will inform, community bankers are, and the owners, whether they're family-owned banks, whether the shareholders are usually uh, in the vicinity, and I think that they will be laser focused on the new technologies. And just like with the credit card companies, I think that new payment rails will exist, and I think we have to make sure that it's open for everybody. JP Morgan, Bank of America may have their own stable coin. But I think it's very easy, and you'll hear, you have two great participants, that you will hear that for community bankers to join together, whether it's in some kind of a cooperative program, whether, but you can private label these under your own name, and it doesn't necessarily have to increase deposit beta. The other thing we're going to do, because we value community banks, we are going to uh, make sure that any new regulation is done in a safe, sound, and not abrupt manner. That there will be a transition and everyone will be able to understand it and participate in it.
Great. Well, I think that's wonderful news for all of our CEOs in the room and everyone listening virtually. I think it's important, as you said, that all banks can participate in this new economic environment, and that we're creating a framework that will allow for safe and sound engagement, as well as ensuring that whatever customers are interested in doing, that banks have that opportunity through a sandbox. That's an excellent idea, and it's great to go back to those ideas from the first Trump administration, where we were actively engaging with office hours, where we would bring in fintechs and bankers to talk about how they wanted to expand businesses in a way that was appropriate and met our expectations.
And I also think too, look, how many people in this room's first savings account was a Christmas club at the local bank? Right. Right. So, are we going to develop the new kind of crypto Christmas club? I like that.
That's an interesting idea. Yeah.
CCC, Crypto Christmas Club. And because I do think one of the great things about crypto is it's bringing young people into the markets, into the financial industry. And I think that community banks that will be at the front line of providing that. You have a natural advantage in terms of going into the schools, in terms of financial education, in terms of financial literacy. Uh, I think Mickey's heard me tell the story. My deep dark secret is that, and a lot of people from South Carolina have it. I have a Dr. Pepper every morning for breakfast. I'm not allowed to do it at home. So, which used to take me to the Circle K on Meeting Street in Charleston, South Carolina. And in there'd be a lot of young construction workers getting ready to go to work. They'd see me dressed like this, and they'd be playing the lottery. And say, Mister, when I win the lottery, will you manage my money? I said, well, the first thing you can do is not play the lottery. But imagine if that group that were involved in digital assets, if they've been putting that $20 of their hard-earned money from construction work, from their blue-collar jobs into digital assets over this time, and it's going to be community banks that do it. It's not going to be the big national banks. So I think that to be able to cater to that audience is going to really provide opportunity for a lot of growth.
Well, I got to say that my theory has always been you can't win if you don't play. So, whatever venue that is, I look forward to seeing how all of those things evolve over the next 10, 20 years, maybe even sooner. But before I ask you the last question about the future of community banking, I want to just touch on some of the legislative proposals that are being considered. There's a big groundswell of discussion about asset thresholds, potentially changing when and how certain regulatory requirements will apply to community banks and other banks of other sizes, including regional banks. How's Treasury thinking about those proposals proposals, and what principles should guide those thresholds as legislators and as regulators are thinking about those going forward?
Well, I think we should think about it in two ways. One, we always think about it inflation adjustments, whether it's for Social Security, sometimes for capital gains. So uh, there's probably a big catch up to do in terms of asset thresholds. Just the economy's grown, the the asset size has grown uh, for bank lending. And like I said, we want to bring it back into the regulated system. So I think that it will be natural to raise many of these thresholds. But then I think you also have to look at what's your book of business, that how risky in terms of how have you grown your balance sheet. Does it look like something like Silicon Valley Bank, that with a lot of deposit beta? So yeah, I think it's those two, but I definitely believe that we do need a substantial increase in terms of the regulatory levels, and maybe even an increase on from the 10 billion of when does the Fed get involved?
I think those are really great topics of conversation. And I think more and more I'm having discussions, as I'm sure you are too, with regional banks who are being frozen at a certain asset level size so that they're not crossing that $100 billion threshold, or a community banker that's being frozen just below 10 billion in assets simply because so many different thresholds of many kinds and different regulations and statutes bite
Or one of the
at that
banks
point.
we had come in, and you would think that if a longstanding big customer came in and put a big deposit in at the end of the year, you'd be excited, but they were, no, we can't take it because it's going to push us over 500 million,
Right.
and then the trigger there. So we want to make sure that you're able to grow without setting off these regulatory tripwires.
Well, I look forward to chatting with you about that going forward and seeing how all of us as in the regulatory space can think about how we can more effectively allow banks to manage for their growth and their size, especially when they're not changing their business model. But finally, on the topic of the future of community banking, over the next 5 to 10 years, how do you see the biggest structural shifts occurring, and how do you think community banks will evolve to meet those challenges in the future? One of the questions that we're asking all of our keynote speakers today is, what does the community bank of 2025 look like?
Uh, 2025 or
Oh,
2035?
sorry, 2035, sorry.
Yeah.
I don't have my glasses on. Yes, 2035. It is already 2025.
Look, so the the ones that make it through the next 10 years will have embraced technology, have embraced financial modernization, and as I said earlier, I think we'll have brought along a whole new generation of young people into the financial world. Because look, there's a whole group just because of the bad calendar, and they lived through the GFC, they lived through COVID, but when I interact with them, they're curious, they want to be part of the system, and it will have been uh, that. And I think that we will see a, I don't know if the branch model is as big as it was. We'll see with that, but I think it's all going to center around technology. And so that's the importance of low cost technological uh, alternatives for the next 10 years,
Not just for 2025.
not just for 2025.
Well, yeah, I think one of the wonderful experiences that we've seen over the past throughout COVID and the Paycheck Protection Program was that we have an amazing industry of community banks that are willing to bend over backwards to ensure that they can support their communities. And I look forward to seeing, hopefully we won't have another experience like COVID where we're asking banks to be, the sole provider of fiscal support or loans for their small businesses to keep their economies running and people employed. But I think it's a wonderful recognition of everything that community banks have done over the past at least 5 years to keep our economy running, to keep our people employed in rural communities and in urban communities as well. But thank you for the support that you've provided.
Yeah, and I think that the other big opportunity is going to be what I saw in the local market in Charleston, South Carolina, was when Boeing came in. Boeing doesn't need, other than people in this building, they don't need to bank with anyone in this room. But when Boeing's second largest production facility came in, there was an ecosystem of more than 200 small factories that sprung up. And the small and community banks, some of the small regionals all moved into Charleston, and they bank every one of those small factories. Some of the factories, some of these startup businesses that have 50, 100, 200 employees. So with this administration's effort to bring manufacturing back to the U.S., I would say when we see, we're talking about bringing back the semiconductor industry, they need 500 companies around them to do that. When we see this precision manufacturing, when you see a multinational company set up, they are going to need a big ecosystem. And the ecosystem, JP Morgan's not interested in the ecosystem. And I think everybody in this room should be.
That's wonderful. Thank you so much for sharing your perspective with us and celebrating the agility and flexibility of community banks to solve problems and to meet needs where they arise quickly. And we look forward to the rest of our day today, and we really appreciate your time this morning. Thank you, Secretary Bessent.
Thank you.